All right, this is being recorded. One thing I mention at the beginning of every single webinar, and I will always mention, is watch this again, especially if you're newer to trading or newer to the way that I teach or my rules and things of that nature. Because the first time through, it might blow by you. A couple of things will go over your head, but the second time through, hopefully that will help your understanding and your memory. There's huge studies that say you study right after you learn something, you will learn, or you will actually know it longer. If you wait a couple of weeks, it's going to be like learning it all over again. So try and watch it relatively soon after. And if you don't want to watch this one again, like if I'm boring or something like that, maybe watch one of my other ones where I brought some heat. I'll try and bring the heat though today. Let me get a couple of things out of the way here real quick. William saying the medical care of all things hitting the healthcare sector today. Oh, Medicare for all things hitting the healthcare sector today. That's what William's saying. I haven't looked at the healthcare sector really in quite a while, probably, for no other reason than I've just not been in it. But let me go over this real quick. My name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading in college with some money I had earned, switched it over from psychology to finance, and then after graduating college, literally packed my bags, moved straight to Chicago, walked onto the floor of the Board of Trade without even ever having made a resume, and started working on the floor, stayed there for over 20 years. So in that time, in those 25 years I've been trading, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products in just about all market conditions. This basically says any opinions, news, research, and analysis or other information contained in this webinar is for general commentary, you guys. At the end of the day, I can't give you investment advice because I don't know your risk parameters. I don't know what's in your portfolio, and I don't know your trading experience, to be quite honest. So bottom line is do your own homework, and please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow me on Twitter at Wolfman's blog. We are in earnings season, so I do earnings trades. I tweet out what I'm doing in those earnings trades, whether I'm doing a strangle, selling puts, selling calls, whatever it is. I'm going to just put out there what I've done. If you've watched the earnings webinars, you know exactly my strike location and everything else. And part of my rules with doing earnings is you do it at the very end of the day, the last hour or two of the day, so that you get a pretty good mark, if you will, for the end of the day, so that your range is still intact. Your probabilities are intact. If you do it early in the morning, you never know what your probabilities of success are going to be until the end of the day. So try to watch those as well, but I'm going to tweet those out in Twitter. But in the daily market commentaries, that's where I talk about all my trades, whether I'm putting them on, taking them off, where I put them on, where I took them off. If it's a winner or a loser, I don't cherry pick. It's every single trade I do, I talk about it. So you guys can follow along. How I'm staying mechanical. You know, if I've taken a strangle and turned it into a straddle to be mechanical, all of those things are talked about in those daily market commentaries. I try and keep them about 10 minutes or shorter, but, you know, just like these webinars, I try and keep it an hour, but they always seem to go over. I have a tendency to chatter a little bit too much, maybe. All right, this again on the broken wing call butterfly. We're going to be doing broken wing butterflies this week and next week. This one is going to be on the broken wing call butterfly, and very similar to what we were doing the last couple of weeks, right? We were doing the ratio call spread and the ratio put spread. Basically, those two are broken wing butterflies where it's actually a cut off wing or something. But we're going to add that extra strike, and we'll make it IRA appropriate. So you will be able to do that. It will also limit some of your risk as well, so you don't have that burden to bear. So we'll build that out nicely. Anyway, so broken wing call butterfly is what I usually call it. Some people call it the skip strike butterfly or the wounded wing butterfly. It's just the broken wing butterfly from my years of studying it. So I will always refer to it as that. All right. This, though, we need a bit of a market neutral assumption. So right now we're kind of getting into that market neutral assumption. If you watch my daily market commentaries, I've been talking about that. I think we're going to start settling down for at least a week or so, unless we see some kind of crazy economic data or some major global change in what's going on, whether it's the tariffs and any of that stuff. That's the only thing that's really going to kick us out of this little bit of tight range that I think we're getting into. So it is good for a market neutral strategy. We can play around with the legs on this so we can be a little bit more biased to the upside, gives us a little bit more room to the upside to be right. But at the end of the day, you don't want it to travel too far north or we will start losing money there. All right, a couple of things we must have. The market assumption must be that it is neutral. You don't want to be wildly bearish or wildly bullish with this one. You want to have something that is going to be in regards to a market neutral assumption where it's going to trade sideways. It may start, not when I say market neutral and trade sideways, you may have some swings in there, but ultimately what it does is it kind of stays right where it's at, kind of what like JP Morgan has done for the past week or so. Let me go back to this real quick because I don't think I finished all of that. So we also need a high implied volatility percent, which is above 50. Okay. I'm not talking about implied volatility. I'm not talking about the VIX. Every single underlying has its own implied volatility. Now, how we find the percent of that volatility is we have to come up with a mathematical equation in the numerator and the denominator. We're going to have two sums. We're going to divide by each other. And it all has to do with the implied volatility of that underlying, but where it is in relation to where it was before. I'll talk about this in a lot of detail coming up. And we want to collect a credit. I like to collect a credit. All right. You can do this for zero. Don't do it for a debit, you guys. When I talk about trading options, and we are increasing our risk, we have to either have something to offset that risk in a sense, right? We have to be balanced. It's like the closer to at the money you go in options, the higher the premium is because there's risk involved in and around that the closer you are. You look way out there at the 1 deltas, those things are trading zero bid at a penny because there's no risk out there, right? There is risk, but there's so little risk that it's not worth really fretting about, and you're not going to get a whole lot of commission for that. All right. So, but we want to at least collect a credit because we are increasing our risk on one side, and that's to the call side. We're going to skip a strike. And that gap is the increase in risk. But what that does is it completely eliminates our downside. All right. We won't have any risk to the downside. So by increasing our risk a little bit to the upside, even though we're market neutral, it eliminates all the downside in that. And you're not going to be able to collect enough of a credit that you're actually happy that this really goes down. It's going to be maybe a quarter or something like that. I wouldn't shake a stick at getting a free quarter if the market went against me. So, you have that going for you. That's a positive, obviously. So, but the bang for your buck is really if it stays market neutral, you'll get the most money for it. All right. And then the setup. Basically, this is similar to what we were looking at, buying one in the money or at the money call. I like to go to the at the monies, just like I did in the broken wing butterfly. Gene's asking what my Twitter handle is. It's Wolfman's blog. And then you sell 2 out of the money calls, and then you're going to skip a strike. Now, what that means is if you're doing $10 wide, then on the skip strike, you're doing a $20 wide, right? The option Montage may go in $5 increments or $2.50 increments. But what I'm saying is if it were a real butterfly, basically, if you did the 1 in the money call, 2 out of the money calls, and then another out of the money call, these two, this buy to the sell is equal distance from the sell to the buy. So it'd be a $5 spread here and a $5 spread here. Now what we're looking at is a $5 to a $10. Okay. So we're skipping that strike, and that skipped strike, that extra embedded call spread in there is what is financing the entire thing. To the downside, it's giving us the credits to eliminate that risk, and it's giving us some upside. All right. And what this is, it's a play on Vega, you guys. We've talked about this a lot. We are in a volatility strategies. This needs to have high implied volatility. You do not want to do a broken wing butterfly in, or probably even a butterfly for that matter, in low volatility. The reason why is these types of strategies, the butterflies, take a really long time to decay. All right. A lot of that has to do with you're buying an equal amount of them. They're very close in strikes. So there's a lot that it usually takes a lot of time for these things to really work out to your max profit. As a matter of fact, the only way to get your max profit is to take it to the very end of the day and it's settled right on your short strikes. Okay. And that isn't probably going to happen. I'm not going to wait for that to happen. That's just way too long to be in this strategy. I'm going to be out of this like I am out of my other strategies as quickly as possible. I don't want to be in these strategies all the way to the end of the day and sitting there nail biting myself, on Friday at 4 o'clock. But this is a volatility on Vega because it allows us to, for one, get that credit. A lot of times, if you don't have the volatility, you are not going to get a credit. You're going to do this broken wing butterfly for a debit. And if that happens, walk away. It can even happen with some of them that have pretty high implied volatility, but it's a rare occurrence. You can probably play around and manipulate it. It could just be where your strikes are. If you're doing the out of the money, you might be just too far out of the money on that first strike you're buying. You might have to move closer to at the money or in the money in order for it to be able to work out to get a credit. Okay. And I've got a couple of examples. We'll play around with that as well. But it's also, we're exploiting theta because theta will decay quickly in the time frame that we are setting this up in. We're not doing this 150 days out. We're doing it relatively close to expiration, as close to 35 days to expiration. That will give us that big theta contraction. I'll show you, I got a better chart of that coming up here soon. But I want to do a real quick comparison here. The traditional butterfly versus the broken wing butterfly. The traditional one, you must nail the number. Like, if you are off and it goes too high or too low, you are going to start losing money. It's got to basically be right where you have predicted it to end. Okay, that is a pretty tough row to hoe. It's also going to give you lower margin requirements. All right, so you do have that going for you. It will be lower margin requirements, but that's because we're selling that embedded short call spread in there. And I'll show you how we set all that up. Just know there's a synthetic short call spread in there helping us finance some of this stuff. All right. But with the broken wing butterfly, we're transferring the risk. We're taking that risk from the downside and moving it to the bullish side. All right. So we've eliminated all of our downside risk, but we have increased our upside risk just a little bit. All right. Protects us from that down move. We will also have a higher max loss. Having said that, that is only on the upside, right? So your probabilities of success with this strategy versus the traditional butterfly are better, okay? Because you have eliminated all downside moves, all right? Which is about a 50-50 probability. So you've eliminated that side of it. That transfers to the upside, which it's not going to hurt us on our probabilities, but it will increase your risk on the upside. All right. And then we're going to need to have our essentials to success. This is where we go through our step-by-step, every one of these when we're coming up with a strategy. Okay. first thing we're probably looking at is our assumption, really, right? We have an assumption. Anytime you've decided you're going to trade an option, you probably have an underlying in mind, all right? So we have that assumption. We're market neutral. We may be worried about the downside, all right? So maybe it's something like United Healthcare where, you know what, I think it's actually finally found its bottom. It's going to settle down here because it's at the point of control or whatever reason you've come up with. It's on a Fibonacci support level. But I am worried if it breaks that support level, it's going to go down, right? Otherwise, I think it's going to stay here. So therefore, picking the right assumption, that would kind of be the assumption we're going into this. That's even before going to the essentials to success, right? So our essentials to success is having the right environment. I mentioned this before. We need to have a high implied volatility percent. And what we're looking at when we're doing the implied volatility percent is going over here to the charts, and we can pull up, say, JDXJ. And like I said, this is the implied volatility. It's just telling us where implied volatility is right now. But in order to come up with the, yes, Banu, we're eliminating the downside by using calls because we're selling a call spread, a synthetic call spread. And I'll show you that here in a minute. But with implied volatility percent, what we're looking at is the implied volatility is 26. And that really means nothing, to be quite honest, you guys. Some stocks will have higher volatilities, like the tech stocks will have, you know, up in the 40s might be their low, where their highs are up in the 60s, okay? So this one's high is up in the maybe 40s at best, and the lows are down in the 20s, where maybe a utility stock like Tesla, or tech stock or something like Tesla would never see an implied volatility in the teens. But what we do for implied volatility percent is take the current implied volatility in the numerator and subtract it from the low. So we have 26 minus 19. So we have 7 in the numerator, and we divide that by the high minus the low, which is 38, minus the low, which is 19, which is 38. So we've got 19 in the denominator. So 7 divided by 19 is about, 30 IV percent without checking myself. That would be what I came up with in my head. And it's 37. If we did all of that out with a calculator, we could probably have come up with 37%. But you got the idea. It was pretty close on that, just by ballparking it. And there's nothing wrong with that. I mean, you can get a pretty good ballpark and know, well, okay, well, it's below what Eric's threshold's at, so let me do the exact calculation. So you can find it here. You can also get it put in your watch list. We have the code for that. You can reach out to us for it. All right, so that's picking the right environment. We need a stock to have an IV percent of above 50, and for an ETF, which JDXJ is, that would be a combination of 25 or more underlines. These are junior gold miners, which are the smaller gold miners. So there's over 25 of those guys in here, and all of their volatilities kind of meld each other out, right? Anytime you do averages, it kind of really melds everything out. So to get above 50 is a tough, arduous task for some ETFs. So we're going to go with an IV percent of above 30 for an ETF. Yes, they will get spikes when that sector rotation happens or something like that. But for the most part, we usually see pretty low implied volatility on these. Oh, I'm trying to change my thing and it's not switching. Are you guys getting these funky lines here? All right, the broken wing butterfly, picking the right underline. One of the things is when we've come up with our market neutral assumption, right? We decided we're going to be looking at the broken wing call butterfly. We know we have high implied volatility percent for this underlying. Now we're kind of looking at it like, okay, well, is this underlying appropriate for trading options? And what we do is any stock underneath $100 our bid ask in the option montage, the options that are closest to expiration, the spot month. And it's going to be a kind of a pick 'em right here, 15 days. I would say basically at the start of next week, everybody's going to be rolling out of this and maybe even already have started to roll out of the March and into the April. And this will, when it starts basically getting closer to 45 days, this is going to be the spot month. This is going to be where everybody is trading. That's where the most time or where the most volume is going to be taking place. That's where most people are going to be watching. So that's the one we're going to be looking at for this rule. And for a stock under $100, we want to look at the bid offer closest just out of the money is where we're looking for this. And they need to be inside of 10 cents wide from the bid to the offer. All right. That tells us there's a lot of eyeballs in there. People are beating each other up to try and better the market. You know, this guy, I was just 63 bid and the guy comes in 64 bid. Now all of a sudden I'm thinking I want to be on the market. Do I move it up to 64 or do I just move it up to 65 to get filled? All right. So, you know, make sure you're in those types of markets. If you're trading a stock under $100 and, you know, it's 15 cents wide or so during open market operations, this isn't necessarily after the market like we are now. Like, you know, you guys probably see this. If you have a day trade in there, after the market closes, all of those orders are gone. And then all of a sudden these markets will widen up. Okay. Obviously. So during open market operations, stock under $100 needs to be inside 10 cents or better on this market. Any stock over $100, we're going to be looking at just moving the decimal like 3 ticks to the left, and 15 cents is what we are going to be looking for. So we'd go over here to the option montage, and obviously Lululemon is not fitting that rule right now. We'd have to check that during open market operations. A lot of times Lululemon is in that camp where they have tight bid asks, all right? But that's what we're going to be looking for. Amgen, we'd need to move it 3 ticks to the left and 20 cents wide, all right? It's not fitting that rule right now, but you can also see there isn't a whole lot of volume and open interest going in here. So they might still be in these front months. You know, so if you go and see you're too far out, 45 days, you can go in here and double check to see, as long as it's not like 7 days to expiration, that's where you're going to see these guys all kind of start widening up because there's not a whole lot of people in there. But you can kind of cross-reference a little bit. Hey, Ted, good to see you back. All right, so that's what we're looking for a tight bid ask. We need to have that tight bid ask for it to be the right underlying. All right. And picking the right duration. I mentioned this, right? We want theta decay. We're going to exploit this theta decay that happened. So we are going to be trying to get this kind of theta component, right? This is theta coming out of those at the money put and calls, okay? We are going to be dealing with the ones that are very close to at the money. So this is going to be a very good representation of that type of theta decay we're having. We're looking out here at 49 days to expiration. You can see it's actually starting to pick up. We get inside this 35 days to expiration and you really start seeing some theta contraction. We get volatility coming out at the same time. What happens when volatility is in here is volatility has a tendency to kind of make this line level out, or at least not go down at the same rate. But then when volatility comes out, it actually rushes to catch up to this. So if we get that theta component and volatility contraction all coming out at the same time, you're going to be able to get out of this trade very quickly. So that's another reason why we want that high implied volatility. When we were looking at those charts before, I think on a couple of them, you can look how volatility will have a tendency to come out really quickly. It cranks up slowly, but when it decides to come out, we get that volatility crush, and that's what we're looking for, okay? We want that volatility crush to happen. Amgen obviously wouldn't fit the rule that I'm talking about. It's only got a 38, 39 IV percent. We want something up in that 50s, all right? So that one's not necessarily going to work out for us. So the next thing we're going to be looking for is picking those right strikes. This could be one of the most important essentials to success aside from knowing our exit strategy. But picking the right strikes. We talked about this a little bit one of the main components of picking the right strikes is making sure that we are doing this for a credit, at least a credit. I mean, unchanged or, nothing. We're not laying out any money other than the commissions we got to pay to our brokerage firms. But picking the right strikes, we need to build this out so we are at least getting a credit for it. All right. And sorry, I went a little too fast. Knowing our exit strategy, we're going to be trying to get out of this trade quickly and for 50% of our max profit. All right. That's where I'm going to be getting out. I hope you guys do too. If you have to try and write it out to the end of the day to get this max profit, you are going to have to be in this contract at expiration and the underlying is trading right there at your pinnacle. All right. That's probably not going to happen. And you're just going to probably be salty at the end of the day. But this is your traditional butterfly. You can see that with these strikes, this is an old example, but it's a good one. You can see that the strike locations are equal distance. We got the 41 to the 44. We got three in between there, or sorry, it's two in between there, 41, 42, 43. So we're skipping 2 strikes there. And then on the upside, we're skipping 4. So we go from 44, or we're skipping 3. We're skipping 3 on both of those. Sorry, I had to put my glasses on. The 41 to the 44, skipping 3. 44 to the 47, skipping 3. Equal distance all the way across. But now, when we break the wing, this is where I was talking about Banu earlier on and everybody else who was listening. This is where selling that synthetic call spread comes in. Basically, what you're synthetically doing with the broken wing butterfly is now taking our traditional butterfly and selling 147 call and then going out and buying the skip strike. This would be the skip strike. So 3 ticks higher to the 50 call, right? So we go 41, 44, sell the 47 and buy the 50 to create the broken wing butterfly. And there we have it. We sold that 47, and by selling the 47 and buying the 50 synthetic short call spread in the broken wing butterfly, it eliminates the downside because we've synthetically collected a little bit of credit by doing that. Okay. We have an unbalanced butterfly. Yes, it could be called an unbalanced butterfly. We always called it the broken wing because you're breaking by selling the 47 and buying the 50, you're breaking that wing. It's a synthetic short call spread in there. What's the difference between a broken wing call butterfly and the call ratio butterfly spread? If you're talking about what I was doing last couple of weeks with that ratio call spread and doing the defined risk, so it would be appropriate for an IRA, we added that short call in there to, or that long call in there to, the long call in there to define that risk to make it appropriate because, you can't have a naked short in an IRA. So what we're doing is we went out and bought a nickel call, which didn't decrease our risk at all, to be quite honest. And that just makes it IRA appropriate. So that's what you were talking about. This one, we are being structured. That other one is just willy-nilly. Wherever I can buy the first call for a nickel is where I'm going to buy it. This one is specific. We are going to skip 1 strike, sell that normal butterfly, and break the wing by moving further out to this 50. Okay. And you can see here with your, your resultant buying power for this one, your buying power effect, $61 on that one because you're doing it for a debit. And then the other one, you're increasing that risk because you're selling that extra call spread in there, increasing it by another $200+. All right. Both are defined. These, if you're talking between the traditional and the broken wing, both are defined risk. And the ones where I was talking about last week with the ratio call spread and then defining that risk by going out and buying a nickel call. We're not buying the nickel call in this one for the most part, unless you're doing maybe a $30 stock or something like that. But we aren't going out and just buying that nickel stock in this one. We're keeping it equal distance so that we can basically eliminate our risk to the one side. All right. I mentioned this before. Our profit target is 50% of max profit. All right. We know what it is right off the bat when we do it. All right. We're going to know what our max profit is. It's basically the middle strike minus the lower strike plus the credit. All right. That's our max profit. Basically what it's saying is that smaller spread, the very first one, not where we broke it. So in my example with BBBY, it was the 41 to the 44 calls, right? That smaller spread. It's $5 wide, or if it's $5 wide, we add that to the credit of, like, say 79 cents. So it would be $5.79 is our max profit. We're looking to take 50% of that immediately. All right. If I can get 50%, I would be very happy. All right. Our max loss is going to be the higher strike minus the skip strike minus the net credit. All right. So that's going to be our max loss. It's basically that extra $5 on the upside. Or actually, it's the extra, it's like an extra $2.50 in a sense, if I'm talking about the $5. Because the break even is the skip strike plus the net credit. All right. After that, that's basically going to start being our loss, right? So with that first spread, that in the example of the BBBY, we can go back to that real quick if I can find it without having to skip through all these. Let's go straight to this. And then with the BBBY, we can look at it right here. It's going to be a little bit easier. So this $3 here is going to help us to the upside, because once we get past that, we're going to start seeing our profits diminish. But if you go all the way out here to the $47.16 is really where our break even is, this little line, because that short strike, that synthetic 47, that's the skip, right? So our break even is the 47 plus the 16 cents. So 47.16 is our break even. Now our max loss then becomes all the way out here to the 50 strike, right? Once it starts going above that, that's our max loss. And our max loss is going to be the remaining $2.84, right? Because we got a $5 spread. We took our break even all the way out to 47.16. So from 47.16 to 50 is our max loss. All right. Is everybody following me there? So your profit, your max profit is much better than your max loss in this. It's going to be better. All right. So let's pull up the trading platform if nobody has any more questions real quick. This is the time where I tell you guys slow out some high volatility stocks. We know that we think are going, or we believe our assumption is they're going to be trading sideways for the better part of the rest of the year. Excuse me. So one of these that has, we don't have a whole lot to pick from, and we don't want earnings in it. These are all going to have earnings, but I want to use this as an example. They're going to have earnings coming in here. We wouldn't want to necessarily set this up tomorrow for this trade. All right. This would have something that doesn't have earnings in it. So let's go look at the option montage. We can see that it's under $100 stock, so it should have 10-cent wide bid ask, and you can see most of these fit that rule even after hours. And then even out here, you can see they are fitting that rule as well, even after hours. So this makes it a tight bid offer. You can see there's some pretty good volume and open interest going on, at least these ones that we're going to be dealing with right now. So our rule was we're going to be picking the one that's closest to the at the money, right? So the one that's closest to the at the money is probably this one. It's slightly in the money, but that's probably what I'm going to go with here. So we're going to buy the 72 and a halves. We sell two of the 75 and 75s. So we sold two of those. So we got $2.50 wide. Now, if I was going to do the regular traditional butterfly, I buy this one, right? But now what I want to do is I want to break that wing. So I need to put a call spread in there. I sell this one and go out and buy the next strike out, right? So we skipped this strike. That's how that synthetic call spread gets put in there, right? We're able to do it for a credit. Let's go down and check it on the Analyze tab real quick. So let's go to the Analyze tab, and you're going to see here, let's delete that one. You're going to see here, I'm sorry my color is going out. It was working earlier today. But you can see here, we get, if it goes down, we get to keep that 26 cents, which is great. If it goes to the top, we are going to get to collect $2.75 from that, right? Because our max profit is this small spread, $2.50 plus the 26 cents. Our max profit is $2.75. We're going to be looking to get out of this thing at about a dollar, what is that, $1.40, something like that, $1.35. Somewhere in between there, that's where we're looking to get out of for our max profit. We would know that getting in. Then our break even basically is the skip strike, which is that 77.5 that I sold, plus the credit, 26 cents. So we could probably line this up and come up with 77.76, which is the 77.5 plus the 26 cents, right? And then our max loss ends up being right down here, just at the 80 strike. So our max loss is going to be $225, right? Because that's the difference between $5 and we got that $2.75. So the balance of that is our max loss to $225. That making sense for everybody right now? So we saw this with high implied volatility. Let's cross-reference that with something that has pretty low implied volatility. Something that's close to $71 if I could find it. You know, let's just, what was it? Let's just go right here because I already looked for it. XLK. XLK, $71 stock, basically, right? But look at the difference between implied volatility. This one's 57. This one is 8. Okay, so we go to the option montage. XLK will have tight bid offers during open market operations. So closest to the at the money, we can look at the in the money to kind of make sure that it's a little bit comparing apples to apples. But let's just look at it this way. So if we are going to be buying the just out of the money one time, and then try and get it as close to what we were doing before with the $71 stock was $2.50 wide, right? So let's skip this and make it a $2 wide one. You can immediately see I'm already out of debit. So if I buy something, my debit's going to even get bigger. So that doesn't work. So let's go in the money a little bit and then go $2 out. So selling the $2 one, hit that twice, and we're still out of debit. And it's not as wide as our last one with the high implied volatility. Okay. So we want to have high implied volatility. Otherwise, this isn't going to work out very well for us. We're just going to have too tight of markets. I mean, we're going to be able to do this. Yes, it will work when we do that. But think about it. Do you really want to do that trade where it's, you know, you don't have a whole lot of wiggle room to the upside, right? And you don't get a lot of credit for taking on this kind of risk. You don't have any risk to the downside, but your risk to the upside is pretty substantial because it's only $3. It's only $2 away, right? So be wary of that. That's why we need that high implied volatility percent, because it shows us that we are at near high volatility for this underlying. And just like we see in the charts where we have these ranges where the stock, you know, you don't see XLK going up to 1,000 and back down to 57 and up to, 2,000 and down to 20. usually it's going to stay within this range probably for the better part of the year. It may break out a little bit higher, but for the most part, we know we're going to kind of be within somewhat of a range. And the same thing happens with volatility. We get these spikes, but a lot of times, and this is a good example with a ETF, how you get those quick spikes and then it slams back down. So that's why I say, an IV percent of above 30, because it spends the majority of its time below that IV percent of 50, okay? What's the duration again? Closest to 35 days, because we're collecting a credit, right? We're exploiting theta decay and taking advantage of volatility contraction. All of those things tell us we want close to expiration, all right? All right, so Herman, the 80 strike have the biggest open interest. Why not the body? I'm not necessarily looking at the open interest for putting these in. I know that if there's this much open interest on the 72 strike, that guy's looking at other things, these other strikes as well, and he probably has spreads in there and all of those things. So if you see a lot of volume in open interest in a couple of them, there's eyeballs on the rest of them as well. Does that answer your question, CJ? How do you create your watch list with all those stocks? Trevor, you basically just punch them in. You go, I don't know, give me a stock, Goldman Sachs, FGS. That's how I feel about Goldman Sachs. And you punch it in like that. It throws it in there. Okay. So you guys get the difference there on why we're doing something like that? You need to have that really high implied volatility percent so that you can get further away. It's pretty simple. And did I explain to everybody how that synthetic short call spread gets put in there? I don't want to confuse you with that. But that really is the essence of why we're able to do this strategy the way we are. And that's why I also said when we're breaking that wing, we aren't doing it like, we're not doing it, for instance, like Target. Let's look at Target again. With my last class, you guys should go and watch those if you have on the ratio call spread. But if we were to look at this the same way, what I was saying on the ratio call spread, if you buy this one and sell two of these, let's say, we got our credit. I said go out here and buy the first one that I can buy for a nickel, which would probably be this one, right? It's going to say butterfly, broken wing butterfly, whatever. It is, in a sense, a broken wing butterfly, but it does not fit my rules for broken wing butterfly. This type of risk, buying that one for the nickel, is just so I can play in my IRA and skirt the system, right? But you aren't decreasing your risk at all because, to be quite honest, you are, I guess, because you define the risk a little bit lower, but I probably wouldn't be taking the other one that far anyway either. How do you select the bullish bias initially? What I do every morning, and I'm going to be doing a little bit of a kind of like what I do in the mornings kind of videos coming out that you guys will be able to take advantage of and watch those kind of, what's my process in the morning? I go through really, and I just look at the charts. I just look at like if somebody's ready to break out or look to settle down, then that's what I'm kind of looking for, right? So I just kind of go through the charts every day and just look at them. And then if I see something pops out at me, or I see something on Twitter, I don't even know where half the time I come up with my assumptions sometimes. I might see something and just be like, I'm going to go fade this guy. So they come from everywhere. A lot of it does come from, though, my morning prep when I'm going through all the stocks. But if I do something late in the day, it's because I've seen something and reacted to it, okay? Or I'm seeing something start to move. I don't have something I'm looking for specifically on any given day. And we put in a GTC order to convert the broken wing butterfly to a risk-free fly. we buy this spread at a price lower than the credit received. CJ, I'm going to have to think about that. Right now when I've kind of gotten in a zone, it's hard for me to think about strategies differently than while I'm trying to think of the next thing to say. You know what I'm saying? So let me think about that. I'll try and take a look at that maybe at the end of the webinar. How is your IV percent different from Toss's IV percentile field? It's not. James, it's not. I mean, when I was doing this is how TD Ameritrade comes up with their IV percent. It goes and it knows that, it puts in 3.3779 and it knows this exact high, which I don't know, 6.339, it's doing the same calculation I am. I'm just telling you how we're deriving that number, because not everybody has TD and not everybody gets the IV percent. But if you know where implied volatility is and can chart it for sure, then we can figure where it is now in relation to where it has been in the past. Does that mean that's where it's going to go in the future? No, not necessarily. But we know from experience that volatility for each underlying has a tendency to stay in a pretty good range bound area. Okay. There is no, what's the excellent commission option rate on Toss? It is basically, when you've been with them for a long time and you beat them up every year. I'd say every year at the beginning of the year, you should call up your brokerage firm, tell them how much you've spent with them and ask them to lower it. You really should. And call somebody else and say, hey, this is what I paid in commission last year. What would you guys do my commission rate for here? And then you can actually go back to your other firm and say, hey, they're going to give me this. I don't want to move. It's a hassle. I don't want to do all the paperwork, but I do want you to at least match what they're going to offer me. Or I will take that and run. And it works. I mean, I did that on the floor for years with different brokerage firms. I would go every year to a different brokerage firm and say, yeah, I'm interested in moving. What can you do for me? And then I go back to my guy. This is what they're offering me. Are you going to match it, or I'm walking? So it's worth it in the end. You can, especially over the long haul. Right. All right. Yes, Herman, it is an adjustment to create a no-risk trade, what CJ was talking about, but I have to figure out if it is possible. All right. What's the excellent, I already did that one. How do you make the adjustment if the stock goes against us? John, it's really hard to make an adjustment with this one because it's defined risk, and we bought that one higher. That one's going to be starting to gain some value, right, as well. So it's really hard to do that. Your reward is better than your risk, and I'm going to be looking at this to play it out in the probabilities because let's go over to the Analyze tab again. When we look at it from a crazy chart pattern, oh, I don't know why it's throwing that up there. Oh, it's because it's got my EA Sports trade on there. It's not what I wanted. Sorry, I was trying to answer somebody's question with the stock adjustment. What was the other question I was trying to just answer? All right, I can't think of that. I just lost my train of thought on that. With the broken wing. Our risk. So our risk, that's what I was talking about. So let's go back to that target example. So the probability, I got pretty good probabilities with this strategy of making money, all right? It's really good, to be quite honest. So when we were looking at this, we were doing the 72.5, selling the 75s, skipping to go to the 80s, right? And we talked about this. Our reward is better than our risk in this strategy. So I am going to be playing this out. I get quite a ways before I start losing money. And if we look at the delta, the probabilities of it going out to this and finishing completely all of my strikes in the money at expiration is only at 20%. So there's a good chance that it'll go up there and hit it. I'm going to play those probabilities out that it comes up and kisses me and comes back down. All right. because the probabilities are 80% that I am going to be somewhere below the worst case scenario. All right. Since you don't want the butterfly to run up past your 50% of max profit, should we set a limit to sell a GTC at the exit when you put on your position? Daniel, I watch all day long, so I always say my mouse is my stop. But if you aren't able to watch it all day long, for sure I would do that. And believe me, there's been times where, well, it was probably just the other day, to be quite honest, when we were talking about the deer trade. I had it on for one day, and I was almost at, I mean, my max profit was 50% of max profit on that. But one day I was at 30%, almost 30% of max profit. And you know, I'm not going to take much risk longer than that, right? I mean, I'm thinking for 50% of max profit, I'm going to be in this trade for at least a week or two. And if I'm at 30% in one day, you know, it's hard to not take that profit off the table. But I guess that doesn't really answer your question. But I have no problem putting in the GTCs so you don't miss it, because there have been occasions where I kind of was like, you know what, I kind of wish I did have that GTC in there to clip me out of it. Can we use this strategy with weeklies? Yes, CJ, you can use this strategy with weeklies. I usually like to stay in the monthlies because that's usually where the most volume and open interest is. But if you're going to be going into those weeklies, just make sure it fits that rule of picking the right underlying. All right. Make sure that there's still a pretty good tight bid ask in there. Because if there's not, you're giving too much edge up on all. Think about this. You got 3 different legs, 4 in a sense, because you're selling that extra one, but really 3 different legs. And if I have to give up 10 cents on each leg, you know, that's a lot of friggin' money to give up, right? So we want to give up maybe 5 cents on each side at best, all right? So we don't have to start from behind the 8 ball. Okay? All right, guys, this is going to be one last week. I think this is the last week we're going to be offering this. It's basically two courses for the price of one. Usually we charge $4.97 for each one of these. Basically what we're going to do is give you guys 2 for 1. So both of these for $4.97. All right. So 2 for the price of 1. One of the things with this one, these are some of our more expensive ones, but these are the ones that are hugely important, you guys. These are some of the things that you aren't going to find online, you know. So this over here, the hacks will let you sleep at night, or sorry, will streamline your process. This volatility crush over here will let you sleep at night. You're going to know so much about the options that you're looking at probabilities. You're no longer thinking about it like it's money. And that's the goal. That's one of the first things I learned on the floor when I started trading. I got my badge. I started trading. A local came up to me and was like, hey, how you doing? I was like, oh, I'm up, you know, such and such amount of dollars. And he was like, dude, you got a long way to go. And I was like, what, dude? That's like my best day ever. And he was like, yeah, once you get over the hurdle of thinking about it as money, that's where you become a true trader, because you're really trading probabilities. You're trading the market. You're not trading to try and think about, am I going to make money? I got to make money on this. I got to do that. All right. Make sure you follow this. You're mechanical. When you're mechanical, you start to do things in a process, and that process is going to make you more comfortable, right? You're going to take the fear out of it. I know all of this stuff. Therefore, I know what I've gotten myself into. I can sleep at night. I'm going to be okay. Over here, streamlining your process. I mean, if I could save you 30 minutes to an hour a day, right? What's that worth in like doing menial things like calculations and silly stuff like that, figuring out probabilities of different things? That's worth a lot of money. It means you can move on to the next strategy. You're going to go through all this math, spend 15 minutes like punching numbers, and realize, geez, it doesn't work. It's not fitting this rule. Now you have to go on to another one, start punching all this math again. I'm going to be able to save you time and energy. So That's worth it in and of itself for the $497, but you're getting it for half the price, and you're going to be able to sleep at night. You're not going to be getting up in the middle of the night, going over and checking your charts and making sure that there's not a breakout or something like that. You're going to be able to be rest assured. I'm playing the probabilities. I'm over that hump of thinking about it being money. And this, the link is in the chat window. No, it's not, Wolfman. Let me try and get it into that chat window real quick. If I can find my correct thing. This is right here. If you're watching this on tape delay, this is what you get to pull up for the, sorry, I had it there. Trying to think and do two things at once does not work well for me, I guess. But what we're saying here is if you're watching this on tape delay, you're going to have to pause it. Actually, by the time I'm done talking, you probably could have not paused it and punched that into your URL. But let me get this over into the chat window for you guys that want to take advantage of this. I got to copy it and throw it into the chat. All right, here we go. Almost done. There it is. It's in the chat window. So we've been going back and forth in the questions box. Over there in the chat window is that link. Also, finally, I just want to thank you guys all for participating in this. And later webinars, I'm going to be drilling down on different options and options components when I find those trades appropriate. Here's also the link. You'd have to pause it if you're watching this on tape delay to punch that into your URL. And thanks for watching. If you have any questions at all, please feel free to reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, guys, thank you guys for all your participation. That's one of the things I love about it is the back and forth, because that makes really webinars come alive in my eyes. So thank you for that. And thank you for bearing with me with some of this stuff. Take advantage of this, and I will see you on Twitter or next week in the webinar. All right? Take care. That's all I got for you. And if you can't take that, take it easy. Take care. Thanks, Ted. Thanks, Nancy. Appreciate it. Wait, Nancy, you said you typed it out. It didn't work. How does the link work? And are you talking about the link for the Pro Trader Strategies link? Yeah, it's going to look like this. It doesn't look like the normal one, but it should pull up to that. And if that doesn't work, we're going to have to put in the promo code. I don't know. Call us. Nancy, give us a call. We'll figure it out. The link is no good. It goes to that other one. Reach out to us. We'll get it taken care of. Thank you, guys.